Welcome everyone, my name is Matt, and in this video I'm going to be covering candlestick charts, so this will serve as a guide for beginners on how to use candlesticks in your technical trading. So if at any point in time you do enjoy this video, be sure to drop a like on it and subscribe to this channel. So when it comes to candlesticks, we'll either have a bullish candle or we'll have a bearish candle. Now these can come in different colors, but typically the most common colors for a bullish candle are green or white, and then for a bearish candle, it's red or black. And the part of the candle that's colored is referred to as the candle's body. Now these bodies don't always have to be this size, so sometimes you might have a candlestick with a larger body, sometimes it might be smaller, but the reason why they're colored so differently between bullish and bearish candles is to simply help us visually differentiate the difference between them, because otherwise we would have to look at the closing and the opening price points if they were the same colors. Now the opening and the closing prices of candles simply comes down to where a candle is during the start of a time period compared to where a candle is during the end of a time period. So let's say that we're still looking at the same 1 hour chart and we're between 6 o'clock and 7 o'clock for this candle's time period, and let's say for this candle's time period we're between 7 o'clock and 8 o'clock. So 6 o'clock would represent the start of this time period, which is when this candle would start forming, and then 7 o'clock would represent the end of this time period or the end of this hour, and that's when this candle would finish forming. So if this candle starts forming and it's priced down here, then this would represent the opening price. So this means that the opening price is always where a candle is during the start of a time period. And so if 7 o'clock is the end of the time period and we're priced up here, then that would represent the closing price. So this means that for every single bullish candle, you will always have a closing price that's above the opening price. Now this doesn't mean that between 6 o'clock and 7 o'clock we went in a straight line from this opening price to this closing price, but this simply just means that exactly at 6 o'clock we're priced over here, which is the opening price, and then once 7 o'clock hit, we were priced over here at this closing price. And so that's how a bullish candle is when it comes to the opening and the closing prices, whereas a bearish candle is the opposite, where you have a opening price that's above the closing price. So this means that at 7 o'clock, which is the start of this time period, we were priced over here, and we moved down to this closing price, which was down over here at 8 o'clock, which is the end of this time period. So for bearish candles, remember that you have a closing price that's below the opening price. And now the outer parts of candles that look like tails are called wicks, or some traders might refer to them as shadows. And these simply represent the highest or the lowest prices that were tested within a period of time that are outside of the candle's opening and closing prices. So this means that if we were to take this candle and move it to the left over here, and let's say that we're still between 6 o'clock and 7 o'clock, and let's say that at 6 o'clock we're priced over here at its opening price, but at 6:15 we decide to drop down to the bottom of where this wick is, so we drop down to this price, and then we move upwards since it's a bullish candle, but at 6:45 we decide to test the high of this wick, so this price over here, before dropping back down and closing right over here at 7 o'clock. So this means that everything that happened outside of the opening price and outside of the closing price would be simply drawn in as the candle's wicks. And so if we see a bullish candle, this means that the buyers managed to overpower the sellers within this period of time because they managed to push the price further up based on having more volume or strength in the market. Whereas if we see the opposite, then we'd see a bearish candle, which means that the sellers managed to overpower the buyers within this period of time and they pushed the price further down. Whereas if the strength between the buyers and the sellers is neutral, then you're left with this doji candle, like the one over here on the right, which means that there's a pause in the market. And they typically have small or practically non-existent bodies, which means that the closing price is the same as the opening price. And if you have a doji with tiny wicks, then this means that there's a lack of volume in the market. Whereas if you have a doji with large wicks, then this typically means that there's a lot of volume or volatility, where the bears are trying to overpower the bulls or the bulls are trying to overpower the bears, but there's obviously a neutral stance. And so typically what we'll see between bullish candles and bearish candles is that if you have a trending market, like let's say a bullish trend, then these trends are likely to be made up of more bullish candles compared to the bearish ones. And even if it's pretty even between the two, then the bullish candles are likely to be much larger in size compared to the bearish candles, which is what's helping push the overall trend much higher over time. And now if you have a bearish trend, then that's the opposite, where you're likely to see more bearish candles compared to the bullish ones, and the bearish candles are likely to be much larger in size, which is what's helping push the overall trend further down. So that's everything for this part, and this will be continued in the next one. So if you found this video helpful, be sure to drop a like. If you want to join a free trading community where we discuss different setups for stocks, forex, and crypto, there's links down in the description to the Discord app as well as the Telegram app. Anyways, thanks for watching.